Hi, hello, namaste, hearty, welcome to yet another interesting I Lead Tax Talks. So, thank you very much, for your wonderful response on the first three sessions that I did. So, as I kept talking to a lot of clients, I felt, I should still, break down wherever that is possible. So, please make sure, that you watch this, you share it with your family, friends, and colleagues that whom you really care for. Yeah. Now today it is PFIC Series 4, and this is a before you redeem again session because PFIC is not just a filing topic; it is an election strategy topic. So if you are holding mutual funds in India and you are in the US tax system, your next redemption decision must be made with the right election in mind. What you see here, like QEF, MTM, and then the default rule. I'll break that down for you. It may be Greek and Latin for you now, but I hope I'll try to make it easy for you before we end this particular live. Now, let's have a quick recap. PFIC 1, in the PFIC 1 series, we spoke about why Indian mutual funds become PFIC for US tax residents. That was the first thing that we spoke about. Then in PFIC 2, we spoke about why Section 1291 is harsh. Why PFICs are considered harsh tax. We spoke about the spread, high interest rate, then the highest rate of tax, and then the interest rate and all. Then in PFIC 3, we spoke about F bar versus FATCA versus PFIC, and we spoke about the compliance clarity and the selling strategy. Now, in today's PFIC 4, the decision maker episode, I would call, we will be speaking about the QEF, MTM, and the default rule, and also the election timing. Okay. Please do give our video a like if you like, what we are presenting here. So today I am taking you beyond generic tax content. So this slide that I have made is designed to give you a strategic international tax mastery. Okay, so even if you are my student from iLead Tax Academy watching this video, these are certain things which we don't read it in the books. Yeah, and these are real-time case scenarios which I very much strongly encourage you to learn this from your practical experiences so that you can counsel your family members, friends or colleagues in the US well. Yeah. Now let's talk a little, about the QEF explanation. See, most other content, shows as QEF. It's hard for mutual funds, but I'll explain you here uh, why. Rather, show you the mechanics and give you the conceptual foundation to evaluate your own tax situation. Then if you have made a late election, you don't know, that you have to make an election, like the QEF, MTM and things like that, and you don't know that you have to amend your tax returns and all. I will cover streamlined procedures, purging elections, and reasonable cost statement. So this is the content that NRIs with years of unfiled 8621s, means the PFICs, desperately, need and don't find it online. And I keep talking, to some clients. Nandaji, I'm in US, my spouse is in India. What if I sell and then, move it to my spouse name? So I'll get into those, gift tax, clubbing provision, and the PFIC free fresh start strategy, for the non-resident spouses also. Probably, a step-by-step, action plan. And also we will talk about the real election comparison. I mean, I'll provide you a side-by-side QEF versus MTM comparison with actual numbers, not just theory. So you will leave knowing exactly which election applies to your situation and why you should opt for that. Next, we will also talk about the US exit consequences. Some feel that let me exit. I mean, with certain uncertainties happening, I think, I'll soon leave back to my home country. What then? So I'll explain, covered expatriate rules, exit tax thresholds, and what happens to accrued PFIC gains when an NRI returns to India, right? Content that you usually, don't find online. And then we will talk about the tactical redemption timing. I'll share the low income year strategy, bonus year avoidance, and loss harvesting coordination, and step by step, planning that converts you into a compliant client. Now, let's take this. Now, paying 20% or 45%. Now, this slide is like the heart of PFIC. Now, paying 20% or paying 45% often comes down to one decision: which PFIC method applies to you, and did you elect on time? See, many investors, they don't realize that Section 1291, the harsh tax that we discussed, is the default. If you did nothing, the IRS assumes the most punitive treatment. So, Section 1291, just to revise once again from the earlier videos, it treats profit like it grew steadily each year. Then it taxes each year's portion at the highest possible rate. So if you were at the 37%, it will tax you at 37%. Adds interest also, which gets you to 45% and all. It removes the long-term capital gains benefit of that 20%, which is usually available for people in the high net worth group. Now, here the slide also highlights a key pain point. You can't even claim credit the way you expect for the taxes paid in India. So, understanding this before selling is the difference between smart planning and a tax shock. Again, when your preparer calls you and tells you that, sir, this is how it is, then it becomes difficult for you. Yeah. Now, let's see, these three resumes. You see the Section 1291, the default rule. Then you see the mark to market, the election that is needed. Then you also see the QEF, qualified electing fund, the election that is needed. Now, if you see here, the interest penalty is by default yes when it comes to the Section 1291 default method. And the long-term capital gains benefit is just no. And filing 8621 is yes. That is the default method. Now, coming to the mark to market method, election is very much needed. I very strongly recommend the clients to go for this. Interest penalty, no, there's no interest penalty when you go for the mark to market. Of course, there's no long term capital gain benefit. That's the disadvantage of having the mutual funds in India. And Form 8621 filing is definitely, yes. So, when you take a mark to market election, you still pay taxes, but you don't have the interest penalty. Okay, that's the beauty of it. Next one, when it comes to QEF, qualified electing fund, here election is needed, interest penalty is no. Long term capital gain benefit may be possible, annual filing is definitely needed, but this practically does not work. Does not work because US expects you to invest in the US mutual funds, US ETFs, not in the Indian mutual funds or ETFs. So the key takeaway from this slide is that 1291, the default harsh tax is the worst outcome, and it is automatically default. So the real skill is making the correct election and then timing it properly. Let's learn that. Now, what is this QEF? See, QEF stands for Qualified Electing Fund. A QEF election makes your PFIC behave closer to a pass-through for US purposes. To put it in simpler words, instead of waiting until you sell and getting hit, with that section 1291 spread and interest, harsh tax and all, you report your share of ordinary income, and net capital gains every year, even if you receive no distributions. Nanda, did you say that right? Even if you receive no distributions? Yes. Yes. The big advantage here is no interest charge, no punitive spreading, and the capital gain portion may qualify for long-term capital gain rates. Now, the critical problem here is Indian mutual funds almost never provide the required PFIC annual information statement. Indian mutual funds. I mean, I see a lot of my clients, struggling. They have a call with me, they sign up for the PFIC services, and then, we have to wait for the PFIC documents to come from them because the process is slow. I understand. Yeah, there are certain processes, but it takes some time. So, without that statement, a valid QEF election generally cannot be made. So, QEF is kind of theoretically ideal, but practically unavailable, for most of the Indian mutual fund investors. Now, let's take a look at this. So, I think this slide was clear as to how QEF works, what's the advantage, and then the critical problem that most of them face. Yeah. You have my coordinates below. Some of them were asking, for the coordinates. So, I put our website, my email address, the US phone number, and the Indian phone number also. So, let's stay connected here. Yeah. Now, let's see this. Uh, let's take an example. See here, the ordinary income is $100,000, 100,000 rupees. Okay. Now, capital gains is 30,000. Now, total reportable is 130,000. Now, no sale required, no distribution required. You report it because the fund earned it. It just increased. So, on your Form 8621, the PFIC report that you file, the ordinary portion will be taxed, up to the marginal rates, means up to 37%. In case you are that high net worth taxpayer falling into that 37% bracket. No, and I'm just a 24% tax bracket guy. Okay, it will be taxed at 24%. So whatever is your highest marginal tax rate, at that rate, the ordinary portion will be taxable, that ordinary income. Then the capital gain portion, it may get taxed at 15% or 20% long-term capital gain rate based on the range of your income. And here obviously there will be no section 1291 interest charge, and basis gets stepped up by income included. So you pay tax on that phantom income. What is that phantom income? The gains you didn't receive in cash. You didn't encash them. The phantom income, that increase. So that cash flow mismatch makes QF challenging even when available, because you may feel that mutual fund value may go down tomorrow also. Now I'm paying tax on this. So that's why people don't go for QEF, because practically it doesn't make much sense. And again, people, I am just making these videos so that you get to understand the seriousness of this and also know how this works. You can do your own research and you can check with your CPA or enrolled agent where you file your taxes from. Just make sure that you're filing your taxes with a licensed CPA or a licensed enrolled agent and not some seasonal shoppers. Because these are very complex matters, so it calls for definitely expertise. Now let's take a look at MTM. What is this mark to market? It's covered under section 1296. So this is the most practical alternative for NRIs holding Indian mutual funds, which I very strongly recommend to my clients. So what's the core concept in this? Every December 31st, you are deemed to have sold your PFIC at fair market value, even if you did nothing. Hmm? every December 31st, the last day of the year, you are deemed to have sold your PFIC at fair market value even if you did nothing. Deemed to have sold. Now, what is this? How do we do this step by step? First, value your holdings, your mutual fund holdings on December 31st. The NAV, the net asset value. Multiply it, by the units, then it gets converted into the USD. That is step number one. Then two, compute the unrealized gain or loss versus the adjusted basis, means the cost. Then recognize the gain as ordinary income, even though you have not sold it, because FMV, treat the FMV, as the sale value. So recognize that gain and then reset the basis to December 31st value. Basis will be again December 31st value. And file form 8621, you will be filing, part 4 annually. So key benefit here is no interest, no historical spreading, and clean forward-looking treatment. Let's see this with an example. Nandaji, maybe that was Greek and Latin for me. Now, this chart shows why MTM removes that kind of a tax shocker. Now, let's say year one, value of a mutual fund goes from 10 lakhs to 15 lakhs. So 5 lakhs gain is taxed as ordinary income. Agree? 5 lakh is taxed as ordinary income. Basis again comes to 15 lakhs. Agree? Cost now becomes FMV. Cost now becomes FMV. So no interest, no 1291 spreading. Just on that increase. Okay, is year one clear? Now year two, value goes from 15 lakhs to 18 lakhs. Now 3 lakhs will become the ordinary income, and now the basis, means the cost, will now be revised to that value, fair market value, on the last day of the tax year. So capital gains will usually be 0. Agreed? Because you're paying tax on that increase, on that value increase. So you pay gradually, predictably, but not a penalty later. That's the certainty in this PFIC. Now, let's take a look, at these two tables, like this is the decision slide, for most NRIs. So both QEF and MTM escape the 1291 interest trap, but differences is that QEF requires PFIC annual statement. MTM does not. Just the NAV is enough. Now, getting that PFIC annual statement and all is usually difficult. Now, QEF tax can be mixed with long-term capital gains. I told you, possibility is there. But MTM is all ordinary. All ordinary. Both have no interest penalty. If you are making this election, one of these elections, both will not have any interest penalty. QEF, according to my 22 years of being in the industry, it is difficult to implement. MTM is practical. For Indian mutual funds, QEF is rarely available. MTM generally is available. So QEF is theoretically superior due to the long-term capital gain potential that it carries. Theoretically, students, if you are watching, or CPAs and enrolled agents from the uh, peer industry you're watching, it is theoretically superior, but practically not possible, because Indian mutual funds almost never issue those kind of statements. So MTM becomes the practical election for most of the NRIs, and far better than the default, section 1291 harsh tax. Yeah. If you still have questions, write to me. You see my email address above, asknanda@elitax.com, and you have my coordinates, in the slide too. Uh, Feel free to WhatsApp me and my team on those numbers. Okay. Now, the question arises, what if you already sold without an election? I mean, I have received like so many queries, about mutual funds, ever since these videos went live. And I'm happy, that people are watching and making an inquiry, about these things. What happens if you already sold without election? So that's the big pain. This scenario is extremely common and extremely costly also. If you sold Indian mutual fund units before making MTM or QEF election, then Section 1291 will be automatically applied and the punitive calculation also will be locked in. That's the worst part. But remedies exist depending on the timing and the facts. So the first thing is purging election. What is this? Treat PFIC as sold on last day of the prior year. Pay the 1291 once, then move to MTM with clean basis. It will be painful, what I am telling you, but take risk properly, calculated risk. Next is the deemed sale election. Recognize deemed sale at start of the MTM election year, the year that you are making the election, and clear any historical 1291 tax taint, for the future years. Third thing, qualified amended return. In certain cases, correction before IRS exam begins may allow retroactive fix. So make sure that if you are filing for PFIC, you amend the returns. Don't just think that if I file my PFIC, that's okay. No, you have to amend your tax returns also. So this is kind of advanced territory, having strict procedural rules, exactly where cross-border expertise matters. So when you're making somebody work on the PFIC, make sure they have a proper EACPA license and they know these cross-border tax solutions properly. Yeah. Now, a lot of clients ask me, um, can I sell and repurchase in my spouse name? She's still in India. Now, this question comes up frequently. If spouse is not a US resident, PFIC rules do not apply to them at all. Fresh purchase in their name creates a clean slate. Getting it? If you're not using MFJ, because I was talking to one of the clients, he's married, but he's still using a single filing status. So if you're doing it in the wife name, that shouldn't be a problem. But if you are using a married filing jointly, it means you are showing her also as a US resident. If she has been in the US with you for at least 6 months, yes, she becomes a resident as per the tax laws. So if spouse becomes US resident, then PFIC begins from the date she became US resident. Are you getting it? To her. So pre-residency period is not tainted. Original purchase price becomes the basis going forward. But you must again coordinate with the gifting tax rules, US gift tax reporting on form 709. Then annual exclusion for non-citizen spouse is usually higher, and India clubbing rules again, section 64 of the Indian income tax, that may apply, clubbing rules and all. Then FEMA, currency conversion documentation, all these things. Yeah. So yes, it can be legitimate planning if done correctly. For that, you need a proper expert. So if you are thinking of moving it, to your spouse name, you have to keep in mind, the US gift tax and then the Indian, clubbing of income rules also important. Now, some clients ask me, Nanda, what if I leave USA after a few years? All these things, do they really matter? Now, it's a big myth if you think that if I move back to India, PFIC disappears. PFIC gains accrued during your US residency, they don't vanish. If somebody is telling you कि संभाल लेंगे, that's not right. H1B departure, no exit tax, but PFIC gains during residency years remain taxable. So Form 86 6(2)(1) obligations for prior years still exist. Let's say somebody is surrendering their green card surrender. So if green card is held for like 8 of last 15 years or something like that, definitely you are a long-term resident. So potential exit will attract tax under section 877A, and deemed sale at FMV, it definitely includes PFIC. Even if you feel like surrendering the green card and all. Now, let's say we take a covered expatriate risk. So if your net worth exceeds like 2 million or average annual tax liability exceeds the threshold, you become a covered expatriate. The mark to market exit tax applies to unrealized gain on all worldwide assets, that too at your ordinary income tax rate. So if exit is planned, do pre-departure planning, because some they want to or have to move to India. So make sure you do proper pre-departure planning. Liquidation and election timing also matter, my dear brother, sister. Take care of that. Now, how about the late elections and compliance cleanup? Now, many clients that I spoke to over the last 2 weeks, they have held Indian mutual funds for like at least 10 plus years, and they never filed this form 8621. So this slide gives those structured pathways to come into compliance without much of penalties. Options, as I told you earlier, also one is amend your prior year returns. See, if you have been filing your FBAR, FATCA and all properly and you just missed PFIC, it is clear that it was not intentional, it was not willful. And also the way the US tax laws have evolved now, with OPA, One Big Beautiful Bill Act and that amended, Tax Cuts and Jobs Act and all, it was not there before. It's applicable right from the tax year 2025. So file the 1040X, your amended returns for at least last 3 years. The statute of limitations mostly, while they say unlimited, but up to last 7 years, that is perfectly fine. So you plan, whether 3 years or 6 years, 7 years, depending on your situation. Attach the form 8621, compute the tax properly, that is one. Then two is IRS streamlined procedures. Means it's like streamlined foreign offshore or streamlined domestic offshore. So file 3 years returns and last 6 years FBARs. It reduces that penalty in most of the cases, because it shows that you acted in good faith. And then obviously reasonable cost statement, as I said, uh, you were not aware of this, you have been filing FBAR, FATCA and all, it was not a willful neglect. So it needs to be drafted carefully, and in most of the cases penalties do get waived. And then the last one is purging election. Pay that 1291 tax on any accumulated gains till date, then elect the mark to market election going forward, and it buys out any historical taint and starts clean MTM regime. So this is where planning creates peace. Filing and all, even an online portal also can be done. You upload the documents and it just returns your draft. Now see, let's talk a little about the strategic timing, because this is sophistication. You have to time your election wisely. Like, all this advice is for free to the online viewers. So sell your mutual funds in a low income year. One, because MTM gains and redemption proceeds, they are taxed as ordinary income. When you say ordinary income, it means it is getting taxed as if it's a W2 income. not like a capital gain income. So try to sell in a low income year, the year you feel your income will be low. Next, spread redemption across years. So even January versus December, sale can shift tax year and reduce bracket drastically. What you want to sell in December 2026, if you sell it in Jan 2027, the tax year changes, because in US tax year is the calendar year, so the tax year changes. And then offset gains with any US capital losses if you have. Coordinate the portfolio sequencing and the carry forward losses if at all you already have. And then next one is plan around the bonus years. Avoid that 37% bracket years, wherever possible. So if you are able to do, all these 5 things, it'll be really good for you. And make sure you elect the MTM before a big sale. Mark to market election. It's really important. Now let's take a look, at a real case study of a client I was talking to. Uh, this client I was talking to only this week, I guess. So he's a Pennsylvania resident since 2022 on H1B. He sold Indian mutual funds in 2024 and 2025. He paid TDS of some 87,000. No prior PFIC filings, no Form 8621 ever. Spouse is in India. She's an Indian citizen, never a US resident. So he is the person I was referring to. So he's been using single as the filing status. So after talking to him, I thought, I'll make this video. So I told him, amend the 2022 to 2024 returns, tax returns, because he came in 2022. And file the 8621 for each year, complete that 1291 tax plus interest, and take FTC, I mean foreign tax credit, for the TDS that he has paid in India to avoid the double taxation. Then elect the MTM, mark to market election, from 2025. So accept that 1291 on the 2024 sale, and MTM prospectively to limit any future damages through the 1291 harsh tax. Then we also discussed about the full liquidation and cleanup, wherein we advised him to liquidate the remaining holdings and use streamlined process for non-willful compliance and eliminate future, annual 8621 burden in case he wants to dispose of. And fourth one is like transfer remaining units to spouse, reduce ongoing PFIC exposure, and again, as I said earlier, it also you also need to analyze the gift tax reporting rules in the US by filing form 709, and also you need to check the India clubbing assessment, as per section 64 of Income Tax Act. So you need a proper tax guy who knows both the US and the India tax laws. So right answer depends on the gain size, the income, and the spouse relocation plan also. So, but I hope you get some clarity about what I'm talking. So if you have a different situation other than these 4 videos that I made on PFIC, please do write to me and I'll be happy to make a video for you. So as you see, PFIC is not about filing, it's about election timing. The most expensive mistake NRIs make is selling the Indian mutual funds before making any PFIC election. Because the moment you sell first, the section 1291 locks in, that harsh tax locks in. Interest compounds, no long-term capital gain benefit, tax at the highest income rates. FTC may help, the foreign tax credit may help, but often not enough, because in India you may be taxed at a very lower rate, but at US you are getting taxed at the highest income tax rate. So the correct sequence is elect first and then sell. Can you say that with me? Elect first, then sell. Yeah, I'm talking to you. Elect first, then sell. Yeah, tell that to your spouse also. Elect first, then sell. Yeah, you can say that to your colleague or friend also. Yeah. The reason why I'm emphasizing it so much is that you will know I'm a teacher by passion, but a practitioner by profession. So I want you to remember this. Elect first, then sell. Okay. And MTM, election before sale, means no interest, no spreading of income, and it is clean and predictable. Getting it? Fine. So if you have watched it this far, I'm truly grateful to you. If you have stayed till the end, I think you have real clarity on the PFIC strategy. So if you want me to cover another topic, just write to me or WhatsApp me on the contact number that's given below, whether you're from USA or India, and whether it's a quick question or a full consultation, we are just a message away. Stay informed, stay compliant, and then stay ahead. You have not come this far, to be penalized, for some not filling of some forms or for some ignorant loss. And one request I have, please share this with at least 3 people you know, whether in family, friends, or colleagues, because 100 clients like you, they create one job for my student at iLead Tax Academy. And also, if your company has many NRIs, people from outside of US, not just India, different geographies, I think I can host a free webinar as part of your employee benefits program. You have my email below. You can write to me, tagging your HR or the finance head, and I'll be happy to do a free webinar for all of you. And finally, don't just file taxes, plan them. Filing anybody can do, but planning only responsible people do. I believe you're a responsible person. If you need a personalized consultation, schedule an appointment. And if you're a married person, please have your spouse along and we will review your iLead. When I say iLead, I-L-E-A-D, income, liabilities, expenses, assets, and then dreams. Income, like all sources in the US and also, outside of US, then liabilities, what you owe and how it impacts tax, expenses like deductions and planning opportunities, then assets, mutual funds, investment, property, and dreams, your future plans, home, children's education, health, you're returning to India, and things like that. You see my Calendly link below in case you want to schedule a personalized tax consultation. You can check the slot that is available, or you can write to me, or you can also WhatsApp us, and I'll be happy to assist you. Thank you very much for watching until here, and I'll see you soon in the next episode of iLead Tax Talks. Please do subscribe to our channel and keep the notification button on. This is not some entertainment video. This is an enlightenment video. Yeah, please do share it with your family, friends, and colleagues. Take care, and I'll see you soon in the next iLead Tax Talks. Bye-bye. Have a wonderful day ahead.